Assalamu alaikum, dear audience. Yesterday we left two MCQs which we have to cover today, and then we'll be moving on to day 3 topics, right? Okay. So can you hear me properly? Kindly hit a message in the chat box. Is the voice, screen share, and everything is perfect? Okay. In front of you in the screen you can see the OT case which we were doing yesterday. Okay, so we missed this point number 3 and 4 because we were running short of time. Now let's cover it. The partnership has 2 private rooms in its premises that can be hired by customers, right? Okay, so they are providing services. It's like hotel service or rent service. That's it. Such customers can book the rooms up to 2 months in advance, at which time they have to pay 25% deposit. They have to pay 25% deposit. See, we are getting advance before the service. We are getting advance before the service, right? Okay. An invoice is then given to the customer on the day after the room hire. On the day after the room hire, with the payment of the balance 75% required within 7 days. Okay. For VAT purpose, the renting out of the room is a standard rated supply of services. Now wait, yesterday we discussed, please be alert, yesterday we discussed tax point for goods. Now this is tax point for services. Tax point for services, they're not that much big difference. Almost everything is same except the definition of BTP, basic tax point. Except for the definition of BTP, basic tax point. Open your eyes, please look at me. For goods, the basic tax point was the day when you deliver the goods. When you deliver the goods to customer, there is only one difference here. For services, the basic tax point is the day when you deliver the service, when you fulfill the contract. That means the day the customers comes to you. Okay, so that's the basic tax point. But the second step, but if you have received advance before the basic tax point, then for that advance amount, the actual tax point is the date when you receive the advance. So for this 25% deposit, open your eyes, we received this deposit 2 months before. So for this deposit, only 25% part, 25% amount, the actual tax point is the date when you receive this deposit. Okay, so your first answer for this 25% deposit is the day or date on which you receive this deposit. Okay, now for the remaining 75%, again come to the basic tax point. Listen very carefully and check 14 days rule. I hope you remember the 14 days invoice rule. If you have issued the invoice within 14 days from the basic tax point, then the invoice issuing date will be your actual tax point. So you can see here, see, an invoice is then given to the customer on the day after the room hire, just one day after the room hire. So one day means within 14 days, so this day when you issue the invoice, this will be your actual tax point for 75% amount. Okay, now let me take okay, you can see, select the actual tax point date in respect of the 25% deposit and 75% balancing. Okay, so for this deposit amount, this is the answer when the deposit is paid. That means 2 months before receiving date of deposit. For this deposit, the actual tax point is the when deposit is paid. Okay, and for balancing payment, this invoice date. Wait. For balancing payment, this invoice date. Okay, right? I hope you got the point. I hope you got it. Now next, the last. I hope you remember a topic that you cannot claim input VAT on certain items. You cannot claim input VAT on certain item, for example, cars used for private purposes. For example, that what we say, private expenditures of owner, and similarly, entertaining customers and entertaining suppliers, entertaining customers and entertaining suppliers. Okay, now read it. Beth and Emmy are planning to make significant changes to the partnership accounts payable and account receivable process and plan to take key suppliers and clients out for dinner. This is simply entertainment. To explain the changes, the VAT inclusive cost of this in the quarter to 30th June 20 will be as follows. See, you have four expenditures. Four expenditure. Now, what the law says? Simple, simple. Entertainment customers and entertainment suppliers. For entertainment customers and entertainment suppliers, you cannot claim input VAT with one exception. With one exception, and that exception is overseas customers. Overseas customers only. For overseas customers, yes, you can claim input VAT. For all other entertainment customers and suppliers, you cannot. You cannot. And still, I can tell you the logic of this also. Why tax department has allowed input VAT on overseas customers? The logic is exports, because overseas customers are connected to exports. Okay, when you entertain overseas customers, there is a chance that your exports will go up, and each and every country wants their export to boost. Okay, so that's the logic. So out of these four numbers, only one number is relevant, that is overseas customers. And look at here, this 775, and see, this is VAT inclusive cost. This is VAT inclusive cost. So here examiner may ask you to calculate the input VAT. So if you want to calculate the input VAT, for this overseas customers amount, and this is inclusive amount, so we all know, just we'll do 775 times 20 upon 120. 775 times 20 divided by 120. That's it. Okay, let's do it. See, it's 775 into 20 upon 120. Wait, let me calculate. Into 129.1. It's this. Closest answer is D. The answer here is D. 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 Okay. Answer here is D. Okay. Okay. Okay, so now let's move on to day three. On day three, we have a lot of topics, so we'll just discuss summaries. We'll just discuss summaries of the topic, and then we'll move on the questions. And today we'll be doing software practice as well. Okay, and it's not difficult. It's very easy. You will like it. No, don't worry. So in your course, there is a topic of employment income. There is a topic of employment income. Okay, so just like property income, trading income, employment income, you have to make the PNL. You have to make the PNL. In front of you there is a PNL. How you make the PNL of employment income? Just concentrate on employees. Just think, employee is earning. So what employee earns, add it. So employees earn salary, bonus, and employee earns different types of non-cash benefits as well, just like car benefit, fuel benefit, accommodation, van benefit, gift benefit, loan benefit. So you have to add all these benefits. They are like incomes. Then, and you all know, you have to deduct expenses as well in the P&L. You have to deduct expenses as well in the P&L, and then you get the final answer of employment income. Now, let me tell you one conceptual thing. Let me tell you one conceptual thing. Listen, normally students do mistake in this. There are two major things in employment income. One is benefit and one is deductions. There are two major things in employment income. One is what we call benefits, and the second is deduction. What do you mean by benefit? Benefit is normally that thing which employee receive, in 99.9% cases. Employee receive that benefit from employer. Employee receive that benefit from employer. Employee receive that benefit from employer. So look at here. So there are two types of benefits in the tax in our tax course. There are two types of benefits. Number one is what taxable benefit. And what is the treatment of taxable benefit? We calculate the taxable benefit and we add it in employment income sheet. See this. For example, car benefit is taxable benefit, fuel benefit is taxable benefit, accommodation is taxable benefit, van benefit is taxable benefit, gift benefit is taxable benefit. These are the taxable benefit, right? So benefits means what employee receive from employer, right? He's getting. This is the identification. The second types of benefits are called exempt benefits. Exempt benefit means employee received, if employee has just received some benefit from employer, but tax department is saying no, it's exempt. We don't want any tax on it. And I hope you remember there is a big list. There is a big list of exempt benefit which you have to read. Okay, right? So there are two types of benefits. Number one is taxable benefit and number two is exempt benefit. What is the treatment of exempt benefit? For exempt benefit, you have to calculate and you have to add it in your employment income P&L. For exempt benefit, you just have to do nothing. Leave them and you will get the marks. Okay. Now, the second thing is what we call deductions. So, now the question is, sir, what is the identification of deduction? How we are going to identify that this line is deduction, this line is linked to deductions? Simple. Look at here. If something is going out of the pocket of employee, if employee is paying something, if employee is getting burden of something, then that is called deductions. Okay. And in our course there are two types of deductions. The first deduction is what we call allowable deduction. That means allowed deductions. The second deductions are called not allowed deductions, right? So only allowable deductions, we'll deduct it from employment income P&L. I hope you remember few of them. There are 5 or 6. There are max 5 to 6 allowable deductions. Now the question is, sir, is there any criteria that why deductions are allowed and how deductions are allowed? Is there any criteria? Yes. You must have read it before. Deductions are only allowed. Deductions are only allowed if they are wholly, exclusively, and necessarily for the purpose of employment. Only wholly, exclusively, and necessarily for the purpose of employment. There must be no duality. Right? Okay, that means only deductions for the purpose of employment are allowed. For example, just giving you example. Today employee went home and he was very hungry. So he ordered some food at home and he spent some money. Now this is not allowable deduction because this is not linked to employment. This expenditure has nothing to do with employment. So this is deductions, but this is not allowed. Employee went home and he took his family for a drive. He took his family for cinema and all. So these are deductions. These will go out of the pocket from employee, but they are also not allowed deduction. Wait, Azan, 30 seconds. Because of Azan, we are quite right. Now, and you might have heard about the famous allowable deductions like employees' contribution in occupational pension scheme is allowed. If employees paying professional subscription fees, it's allowed. Incremental marginal cost of working at home is allowed. Mileage allowance is allowed. Qualifying traveling expenses are allowed. Insurance for third party liabilities by employees also allowed. Okay. Now, look at the sketch very carefully. Look at this sketch very carefully. This will definitely come in your exams for sure. Now, there are two people in front of you. One is employer and the second guy is employee. One is employer and the second guy is employee. Now, hold. In UK, if you are an employee, you go to UK and your status is employee. So you have to pay two things. You have to pay two things. Number one, you have to pay class one employee NIC. You have to pay class one employee NIC and you have to pay income tax. And the third thing, in UK, if you are treated as employee in UK, if you are treated as employee, then your income will be, then on your income, employment income rules will apply. I repeat, listen again. Let us say you are in UK and your status is employee, you are just an employee, right? So then your whatever you are earning from your employer, your income will be treated, which rules will apply? Employment income rules will apply on your income first. Number two, you have to bear the burden. You have to bear the burden of class one employee NIC, and you have to pay income tax as well. You have to pay income tax as well. Now the question is, sir, how are we going to, on which amount are we going to calculate class one employee NIC? Class one employee NIC is normally calculated on cash earnings. Cash earnings, let me tell you the famous names. Number one, cash salary. Number two, cash bonus. And number three, mileage allowance received. If you drive your own car for your employer, then sometimes your employer pays you something. Sometimes your employer pays you something. So those payments, if they are excess of 45 pence, if they are excess of 45 pence, then excess will be added. Then excess will be added. In short, you just mark two words: cash salary and bonus. So class one employee NIC is calculated, the class one employee NIC is calculated on cash earnings. Okay. Now Sir, what are the rates? You can see in the beginning of your kit, it's available everywhere. You can see the first band rate is nil, then 12% and 2%, nil, 12 and 2%. Okay. Now, second case. In UK, if you are employer, in UK, if you are employer, then each and every employer has to pay some NICs for their employee. Each and every employer has to pay some NIC for employee. The first NIC is class 1 employer NIC. The class 1 employer NIC. Question, sir, on which amount do we have to calculate class 1 employer NIC? On the same amount, on which you have just calculated class 1 employee NIC, you have to calculate class 1 employer NIC on the same amount. You have to calculate class 1 employer NIC on the same amount. Okay, right? That is on cash earnings. One more thing, I hope you remember, there is an employment allowance. There is an employment allowance given by tax department on class 1 employer NIC. For example, I am an employer and I have 5 employees. So first I'll calculate the class 1 employer NIC of all those five, and I'll add all those NICs of those 5 employees, and one time I'll deduct 3000. That's the relief. And this relief is only for class 1 employer NIC, not for 1A NIC. Now, sometime it happens that employer not only gives cash salary, cash bonus, but also non-cash benefits. So if employer is providing non-cash taxable benefits to employee, if employer is providing non-cash taxable benefits to employee, then employer also has to bear one more NIC, and that is class 1A NIC. That is class 1A NIC. See, I've written with red pen, only on non-cash taxable benefits, only on non-cash taxable benefits, right? Okay. Now, what is the rate? This is a flat for class 1A NIC. There is a flat rate. 13.8%. You just apply and you got it. You just apply 13.8%. You just apply 13.8% on non-cash taxable benefit, and you get class 1A NIC. Now, as open your eyes, see, I have highlighted it. As these two, open your eyes, as these two NICs are paid by employer for their employees, that's why these two NICs are allowed expense from trading income P&L of employer. Class 1 employer and class 1A NIC are treated as an allowed expense, from trading income P&L of employer. One more thing, please open your eyes, be active, my dear student, please. One more thing, if you have employee and you are not giving him non-cash benefits, then there is no need of class 1A NIC, then you only have to pay class 1 employer NIC. Okay. Now let's change the direction. If this employer is human being, if this employer is human, I, in Urdu we call it insaan ka bachcha. If this employer is human being, then obviously he will get old, obviously he may lose his business, he becomes unemployed, and he becomes zero, so he may go to government for benefits. So government says, if you are human individual, if you are human and individual, then this employer has to pay, this employer as a businessman, he has to pay NIC for himself as well. He has to pay NIC for himself, and these two NICs are class 2 NIC and class 4 NIC. I hope you remember class 2 and class 4 NIC. Then class 2 and class 4 NIC, employer is giving for himself, not for employee, for himself, for his own. Okay. Class 2 and class 4 NIC. Class 2 NIC is around £3 per week. Okay. And for class 4 NICs, there are certain bands, and the rate is 0%, first band 0%, then 9%, and then 2%. One more thing, my dear student, class 4 NIC is calculated. Class 4 NIC is calculated on tax adjusted trading profits. Class 4 NIC is calculated on tax adjusted trading profit, right? Okay. Now, as, read this line, these are big mistakes. See, 2 marks and 1 mark is also very important. As class 2 and class 4, as class 2 and class 4 NIC are paid by employer for himself, class 2 and class 4 NIC are paid by employer for himself, so it's not, they are not paying for employee, so that's not an allowed expense. It's just think, class 2 and class 4 NIC are the tax of employer himself, and your own tax is not an allowed expense. Your own tax is not an allowed expense. Okay, now there is a big dodge, big mistake in examiner reports. It is written, and many students do this mistake, so please, you guys don't do it, you guys don't do it. Listen, if employer is a limited company, for example, you are doing a question of Arable Limited, Zhong Limited, this limited, Soft Tap Limited. If the employer is a limited company, then this company is an artificial person. This company is artificial person. This company won't get old. It's not human being. So then no need to pay class 2 and class 4 NIC. Then in that case, company never pays class 2 and class 4 NIC. But yes, if company is hiring employees, then company has to pay NICs for employee, like class 1 employee and class 1 employer and class 1A, class 1 employer and class 1A. Okay, so my dear student, this sketch is very useful. You have to keep this chart in your mind. Okay, don't forget it, please. Now, I sometimes do this activity with my students. And this is very useful. MCQs and OT cases are very dodgy. We never know what happens in the exam room. Okay, only students know. Now listen, I have written few incomes in front of you. For example, see, property income. Just think, if your property income is going up or down, will there any effect on NIC? No, because there is no NIC on property income. Okay. Number two, if your employment income is going up or down, yes, there are NICs. Your NIC gonna move. Class 1 employee NIC, class 1 employer NIC. Yes. So when employment income moves, this is relevant for NIC, right? For capital gains, no NIC. For capital gains, no NIC. Your capital gains are, if your capital gains are millions or trillion, don't worry about NIC. On IHT, there is no NIC. On IHT, there is no NIC. Okay. On interest income, there is no NIC. It goes up or down. Don't worry about it. No NICs on interest income. On dividend income, there is no NIC. On dividend income, there is no NIC. On pension income, there is no NIC. Don't worry about it. Okay. But yes, on trading income, you have NIC. On trading income, class 2 and class 4 NIC. On trading income, class 2 and class 4 NIC. One more dodge. Class 2 NIC is a fixed thing, like £3 per week. So if your trading profit moves, class 2 NIC won't change. But yes, class 4 NIC is percentage based. Class 4 NIC is percentage based, my dear student. Class 4 NIC is percentage based. Okay. So yes, if your trading income fluctuates, your class 4 NIC will move. Okay, right? These are basic things. Now, look at this case. This is a real life case, and this happens in all the countries, right? See, I have written, and I will discuss a practical question, the planning question with you guys of this. Okay, today I will discuss a question related to this, but I'm giving you a basics right now. Okay, so that at the time of question you will quickly pick up. Here you have a school. You can think school as an employer. Okay, and here you have a teacher. Now, my dear student, hope you remember, there are two types of teacher. The first is school teacher. There are teachers who work 8 to 2 morning, 8 a.m. to 2 p.m. They are under the control of the school. They have to teach what the school principal is saying. Okay, teach this topic, what to do and how to do. Everything is told by the school principal. Okay, the salary is fixed, right? You can't enjoy any benefit from, sound management. You are not on profit sharing with school. You are just a fixed salary employee. So in this case the teacher, in this case the teacher will be treated as employee. In this case teacher will be treated as employee, and when teacher is employee then school will be employer. When teacher is employee then school is employer. In this first case, the fixed salary teacher which I just told you, this teacher will be treated as employee, and his income will be treated as employment income. His income will be treated as employment income, and now on this employment income he has to pay income tax. This employment income he has to pay income tax. This employment income he has to pay class 1 employee NIC. This teacher has to bear the burden of class 1 employee NIC. Okay, so the case number 1, teacher is employee, teacher is treated as employee, so his income is employment income. He has to pay income tax on employment income. He has to pay class 1 employee NIC. He has to pay class 1 employee NIC, right? Okay, now when this teacher is employee then school is employer. When teacher is employee then school is employer. Then school has to pay class 1 employer NIC on this teacher's behalf, and class 1A NIC if school is providing non-cash taxable benefits. Okay, one more thing, when teacher is employee, open your eyes, when teacher is employee then school is employer. When teacher is employee, school is employer. Then school has to deduct pay as you earn. I hope you remember, school has to deduct pay for this teacher and submit to tax department. Okay, these all are the consequences. But there is one more case which is possible. There are teachers, have you seen in especially in Pakistan market, many of the ACCA teachers, they are not employees, they are self-employed. Or we use the word visiting faculty. Okay, so they are independent, they work with their own wish, they just ask what to do, how to do, it's their own wish. If a teacher is teaching F6 in Karachi, normally it's his own wish to start with property income, to start with value added tax, that's their own wish. Okay, so they are no employees. Plus many of the teachers are sharing income with the institute. They charge percentage on receipts from the institute, so they share risk as well. So such teachers are not employees at all, they are self-employed. In short, we can say they are businessmen. So if the teacher is self-employed, then teacher's income will be treated as trading income. Then that teacher's income will be treated as trading income. Yes, he has to pay income tax. He has to pay income tax on trading income, and he has to pay class 2 and class 4 NIC. He has to pay class 2 and class 4 NIC. He has to pay class 2 and class 4 NIC, right? Okay. Now, in this case, when teacher is self-employed, in this case when teacher is self-employed, then school is no more employer. So school won't be paying any class 1 employer NIC or 1A NIC for this teacher. Plus school won't be maintaining any pay thing for this teacher. Okay, right? So you must know these things and tips. These are very very common areas in your papers. Now, quick recap for trading income chapter. Quick recap for trading income chapter. I hope you remember, normally every business keeps an accountant, and accountant prepares accounting P&L, and accountant prepares accounting P&L. And my dear student, accounting P&L is prepared with keeping in mind the rules of accounting. But when you go to tax department says different, but there are some differences. So then what we have to do, we have to convert, my dear, then we have to convert accounting net profit into tax adjusted trading profit. See this journey, I call it a journey. accounting profit to tax adjusted trading profit. You have to adjust few things. You have to adjust few things. For example, giving you a very little example. In accounting books, we book depreciation, accounting depreciation expense. But when we go to tax department, they say, sorry, we don't allow accounting depreciation. We don't allow accounting depreciation. Accounting depreciation is not allowed because accounting depreciation itself is an estimation, and tax department normally does not allow tax depreciation. Okay, why? Because it may create a lot of frauds. We can do a lot of frauds with estimation. Okay, so in short, this is a big journey. This is a journey, accounting net profit to tax adjusted trading profit, and we have to do few adjustments. Now, giving you a very outclass summary in front of you. Now, I hope you can see this. See, there are total four adjustments. There are from if you start the journey from accounting net profit, and if you go to tax adjusted trading profit, there are four adjustments. The adjustment number one, this is the adjustment number one. Add back let me read the full name. Add back all those expenses which are allowed in accounting but not allowed in tax for as a trading income deduction. There are expenses which accountant has already booked, which accountant has already deducted from accounting P&L, but when you go to tax department, they say get out, we don't allow. So obviously we have to add back. And there is a big list which you can see. Open your eyes. Accounting depreciation, entertainment customers and suppliers, general provision, many things, political donations, gift aid donations, special tax advice, many things are not allowed. And all not allowed capital expenditures like improvement, all not allowed things you have to add back. All not allowed things you have to add back. Okay, now the second adjustment, look at here. Incomes taxable as trading income but excluded from accounts. Wait, this is very little adjustment. There are some incomes which are not treated as income in the accounting books. There are some incomes which are not treated as income in accounting books, but when we go to tax department, they say, oh, for us it's a taxable income. Come on, add it, we want tax on that, on it. Now the question is, sir, is there any example? Yes, there is only one example, and that is stock drawings. Please be careful. It happens sometimes we take goods out of our stock and we go to home. Okay, so normally there are two policies of traders. Some people take goods home cost to cost, and some people take goods home free of cost without paying anything. So the rule of tax department, they say, if even if you are selling goods, if you are transferring goods to your own home, they will treat it as if you have sold at market price, as if you have sold at market normal selling price. Okay, so the two cases may come if you look at here. If you have taken stock at home cost to cost, then you just have to add profit. Please, I need your energy. I need your energy. And if you have taken goods free of cost, then my dear, you have to add complete selling price. Okay, right? So out of these two cases, any one may come. Now the third adjustment, this is less. Incomes added in accounts but not, they are not trading income. Listen, I hope you all have studied F3, and I say F3 pass student as accountant. Okay, so you are all accountants. Have you ever seen the accounting P&L? In accounting P&L, it's sales, cost of sales, gross profit, and add other income. Accountant normally add interest income, dividend income, other gains, and lot of things, right? Rental income. So in accounting net profit, many incomes are already added. By accountant, and they are not trading income. So tax department will say, right now we want trading income. Right now our journey is to go to trading income. So why you have added other sources of income? They are different income, their heads are different, so we say, sorry, okay, we are deducting, we are deducting. So if such incomes are already added, then you have to deduct it, and there are simple some examples in tax department where they say, now finally, less expenses. There are some expenses, less expenses not allowed in accounting but allowed in taxation. No, wait, these are only few. There are some expenses which are not treated as expense in accounting world. In accounting world, they are not expenses. So that means if in accounting world those expenses are not treated as expense, that means accountant has not already deducted, such expenses. But when we go to tax department, they say, they say, come on, deduct it, we are allowing you. Okay, deducted. So you need to deduct such expenses. Okay, so the most famous expense in this category is capital allowance. What do you mean by capital allowance? Capital allowance is basically tax allowable depreciation. And what's the logic? Listen, as tax authorities do not allow accounting depreciation, as tax authorities do not allow accounting depreciation, so as a gift, as a substitute, they allow their own depreciation, which we call it capital allowance. So I sometimes say that capital allowance is basically the ready-made depreciation given by tax department. Capital allowance is basically the ready-made depreciation given by tax department. And same is the case with this amortization of lease premium. Amortization is lease premium. Sometime you buy property on lease, on short lease of less than 50 years. So you might have studied for that lease, if you pay premium, so, and you are using that property for business purpose, and you are using that property for business purpose, then there is a special amortization of lease premium will be allowed for tax purposes, and that amortization has not already deducted in accounting records. That amortization has not already deducted in accounting records, so you have to less it. Okay, so this is a summary of trading income. Can please check it? This is the summary of trading income. You can see this is the summary of trading income. Okay, now Now, a summary of capital allowances. A summary of capital allowances. Capital allowances. Now listen. Normally, when we go to tax department, for capital allowance, when we go to tax department for capital allowance, they normally don't allow capital allowances or single asset. They say, go, come, bring complete combination of assets. So normally they allow with pool. So there are two pools in our courses. One is main pool or general pool, and second is a special rate pool. One is main pool or general pool, and second is a special rate pool. Okay, right? Now, what things come in a special rate pool? You have studied in a special rate pool, normally thermal insulation, expenditure on thermal insulation, long life assets, integral features of building, and those cars with CO2 greater than 110. Those cars with CO2 greater than 110 are normally comes in special rate pool. Okay, I often tell my students that learn 4 points. Listen, for a special rate pool, Thermal expenditure on thermal insulation, expenditure on long life assets, integral features of building, and cars with CO2 greater than 110, and cars with CO2 greater than 110. These things come in special rate pool. All the remaining things, just for your convenience, all the remaining things will come in main pool, okay. Now, what is the format of these two pools? What is the format of these two pool? The format of these two pools is simple. It's written in front of you: opening balance, add additions, opening balance, add addition, less disposal, opening balance, add addition, less disposal, you will get final balance. Opening balance, add addition, less disposal, you will get this final balance, okay. And on this final balance, if you are working on main pool, if you are working on main pool, then the WDA, written down allowance, WDA rate is 18%. You can claim 18%. But if you are working on special rate pool, if you are working on special rate pool, then the WDA rate is 6%. Then the WDA rate is 6%. Now, the question is, what is the depreciation method are we following here? It's reducing balance method. If you remember the accounting rules, we are applying percentage on NBV. If you remember the accounting rules, we are applying percentage on NBV, we are applying percentage on NBV. So this is basically reducing balance method. One more thing, you might have studied depreciation policy when you were kids, when you were in F3 or O levels, A levels, your Cambridge system. There are two policies of depreciation, booking depreciation expense. One is yearly basis and second is monthly basis. Here you have to strictly apply yearly basis. Yearly basis means full in the year of purchase and none in the year of sale. Full in the year of purchase and none in the year of sale, right? Okay. And one more thing, when you deduct any disposals, from here, you might know this, that you have to deduct lower of cost or DP, lower of cost or DP. Two things you have to write in front of you. Number one is cost and number two is disposal proceed. Whatever the lower amount you have to deduct, whatever is the lower amount you have to deduct, that amount you have to deduct that amount, okay. Now, sir, are we depool any assets? Are we do depool any assets in capital allowances chapter? Yes, there are two assets which we have to depool. Number one is privately used asset by owner. Look at me. Privately used asset by owner. Privately used asset by owner, right? Okay. And if it is written that employee is using privately, then it's irrelevant. It doesn't matter. Only private use by owner is relevant. Okay. So such assets will be depooled, compulsorily depooled, right? See, depool means separate column. Depool means they will be written in a total separate column. Now the question is, sir, what if we have two or three privately used assets? Sometimes you can see your exam kit as well. Sometimes it is written that the car 1, car 2, car 3, these are three privately used assets. So you have to make three separate columns for car 1, car 2, and car 3. This is must, okay? Don't combine it. So privately used assets are, wait, privately used assets, privately used assets are always depooled separately. And now how are we going to work on it? Listen, first compute normal capital allowance. For example, you have a privately used car, with CO2 emission rate of 100 grams. You have a privately used car with CO2 emission rate of 100 grams. I hope you remember that for CO, if the car has a CO2 of 100 grams, that car's WDA rate is 18%. So let us say you have a car of 10,000, you'll apply 18% on it. 10,000, 18% is 1,800, okay. First compute normal capital allowance for privately used asset. Always first calculate normal capital allowance, and then apply the business use percentage. For example, see, in my case, I have assumed 60% as the business use percentage. So 1800 times 60%, this will be your capital allowance that will go in the right column. Okay, right? One more thing, there is one more depooled asset in our course, and that is SLA, short life assets. Short life assets are basically related to general pool family. Short life assets are basically related to general pool family, and they are by option, they are not compulsorily, you don't have any compulsion to do depool it. They are by option, they have allowed, if you want to depool it, you can do, right, for short life assets. But normally examiner does this work ready made for you. They normally depool SLA, short life asset, for you. So what you do, you simply apply 18%. You simply apply 18% on short life asset. 18%, sir, why 18%? Because short life assets are connected to main pool family, now wait, there is one more thing, which is AIA, annual investment allowance. This is for motivation. This is for motivation to buy new plant and machinery, to buy more and more new plant and machinery. And this figure is now 1 million. AIA is now 1 million for 12 months accounting period. Again, one very important thing, biggest mistakes by students. Listen, even in examiner reports, they have written this, and I'm sure you guys won't do it. Whenever you start any capital allowances question, just first of all, the first step, you have to count the months, accounting period months. First of all, you have to count accounting period months. Let us say your accounting period months are 9 months. So now in within second you have to think over it, that if your accounting period is only 9 months, now you have to apportion WDA of main pool, WDA of special rate pool, and all WDAs are to be apportioned with respect to 9 months. Plus you have to apportion your AIA as well. AIA for 12 months accounting period is 1 million. AIA for 12 months accounting period is 1 million. So if you apportion it, if you have a 9 months accounting period, so automatically your AIA will be 7,50,000, right? And you know how AIA works. AIA, because of AIA, if you buy a lift of 3 lakh, this complete 3 lakh 100% amount will go to the allowance column. You will get immediate allowance. So it's a motivation, to buy more and more asset, to invest more and more in the UK economy, now listen, hold, hello, जी 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 नहीं नहीं, मैं आज मैं सॉफ्टवेयर पे सॉल्व कराऊंगा, डोंट वरी, वो हो जाएगा. Sorry. Now, so one very important thing, no AIA, strictly I'm saying no AIA on cars, they are not motivating you, UK government not motivating you to buy cars. Okay, so strictly no AIA on cars. Now for AIA, what is the priority to use AIA? I have not written here, but I am orally telling you. In your question, sometime you buy some assets of SRP, sometime you buy some assets of main pool, sometime you have a privately used asset, lot of assets you can buy in one accounting period. So how you are going to use your AIA? You can write, if you want to write, you may write. First of all, always first priority is SRP assets. Give first priority to SRP assets, then main pool assets, then short life asset, SLA, then SLA if you have bought any SLA, and finally privately used assets on the last priority. Because of privately used assets, because of private use, you have to lose some of your capital allowance. Now, few things just pointing out. for depooled assets, depooled assets mean those who are written in the separate column, like SLA and privately used asset by owner. For depooled asset, whenever they are sold, we do complete balancing adjustment on the same day. Complete balancing adjustment, like complete balancing allowance or balancing charge, comes on the same day and it goes on the right column, immediate. But for pooled assets like main pool or SRP assets, balancing adjustment is done. Yes, on the disposal of that asset, balancing adjustment is done. Look at me. But it is done over the period of life. Slowly and gradually. Okay, for main pool and SRP, But there is one exception, and it comes in exam. There is one exception on which in which we have to do balancing adjustment immediately for everything, and that is closure of business in the year of cessation. That means in the year of closure of business, you have to compute real depreciation for everything. You have to do balancing adjustment for main pool, special rate pool, and everything. Why? Because this is the last chance, this is the last year of business. You won't be able to claim anything next year. This is the end of business. So read these lines, last lines. In the year of closure, see, in the year of closure of business, we don't compute any WDA. No more 18%, no more 6%, no AIA, nothing. No more such things. Only we compute real depreciation, that is balancing adjustment. Only we do real depreciation, that is balancing adjustment, in the year of closure. There are questions in exam kit for this. Now this slide is for cars. One line. In UK government has connected cars, the capital allowances chapter of cars, with CO2, with environment. Okay, cars are totally connected with CO2. Okay, now first line. In case of new cars, open your eyes, I have written the word new cars with CO2 less than 50, grams per kilometer or less, then 100% first year allowance is available, immediate. But this car should be new. If you have bought a new car plus the CO2 is 50 grams or less, 50 grams per kilometer or less, then you get immediate 100% first year allowance within seconds. And one more thing, very important. We never apportion first year allowance according to accounting period. No matter if your accounting period is 9 months or 6 months or 3 months or 2 months, still you will get complete 100% first year allowance. Second, read the second bracket. This, if your car has a CO2 emission rate of 51 to 110, or no matter it's new or used, this car will go in main pool. That means 18%. Third point, if your car has a CO2 emission rate between 0 to 50, but if this car is used car, not new car, it's second hand car, it's used car, then again you have to do 18% on main pool. Then again you have to do 18%. You have to take this car in main pool. Okay, and last but not the least, if your car has a CO2 of more than 110 grams, like 120, 130, 140, and no matter this car is used or unused, second hand or new, this car will simply go in special rate pool. Right? Okay, one dialogue is again constant. No AIA on cars. Never. No AIA on cars. This thing I have already taught you. We never apportion first year allowance according to accounting period. Take 30 seconds and check it. This I also taught you, but you can read it. Privately used asset. Privately used means by owner. If owner is using privately used asset, then you have to apply that privately used asset topic. private use of employee is irrelevant. Employee's private use is irrelevant. You have to close your eyes. You have to close your eyes. If it is written employee's private use, you don't need to take to depool that asset. Okay. One very important, this topic not for companies. This topic not for companies, is strictly not for companies. This is for individuals. Okay. Because why? If company is the owner, company is not human being. Company is not human being. Company cannot use any asset privately. Company cannot use any asset privately. But yes, company employees like directors are also employee of the company. Company employees can use assets privately. And this dodge normally comes. This dodge normally comes in exam. In corporation tax question, they forcefully add such things. In corporation tax question, they intentionally add private use, but you have to close your eyes. You have to ignore that private use element. You have to ignore that private use element. Okay, right? You have to ignore that private use element. Now, this is also a very, very short topic. This is also a very, very short topic, and sometime it comes. You never know. It may take your 1 mark. Low balance in any pool. This topic applies on main pool separately and SRP separately. Both pools. This may be applied on both pools. For example, see, you have opening balance of main pool of 50,000. Open your eyes. You have main pool opening balance of 50,000, no additions, and the disposal is 49,200. Main pool opening balance of 50,000, no additions this year, and the disposal amount is 49,200. So the balance in the end is 800. The balance in the end is 800. Now look at me. Whenever you get a balance of £1,000 or less, you get a balance of £1,000 or less in main pool or special rate pool. In main pool or special rate pool, then you are not allowed to apply 18% or 6%. Just take the complete amount. Just take the complete amount in allowance column. Just take the complete amount in allowance column. Just take the complete amount in allowance column. Okay, this is a relief. That means you are really poor, very low amount left. So tax department say, okay, take it. Okay, take it, right? So don't forget this 1,000 number. Now listen, we are taking a short 5 minutes break, a 5 minutes break, our first break. Okay, so get yourself refreshed and then we can continue. Okay. Okay, welcome back, students. Wait, हेलो. हाँ बस अब शुरू ब्रेक खत्म. Okay, welcome back, students. There is a one-page topic in your course that is cash basis. That is cash basis. The traditional trading income which we studied was on accrual basis, and this is what cash basis. First of all, keep it in mind, this is only for individuals. This topic is only for individuals, not for companies. Not for companies. Okay, right? Now let me start my discussion with a double entry. Wait, can you see this double entry? Wait, the first entry and the second entry. In the first entry, if you are following accrual basis, so your sales will be 48,000. If you are following accrual basis accounting, your sales is 48,000. But if you are following cash basis, then you have received only 45,000, right? Similarly, see the second entry. In the second entry, if you are following accrual basis, then the purchases, your expense is 40,000. Your purchases is 40,000. But if you are following cash basis, then what is your outflow? It's just 38,000. Okay. So my dear student, keep it in mind that if you follow cash basis, so your P&L will be very simple, like receipts less payments. That's it. Receipts, cash coming and cash going, receipts less payments, receipts less payments. Okay, now some quick recap here. First line, in the first line I have written everything on cash basis. Everything on cash basis, that means receipts less payments. That's it. You have to follow receipts. Now here, revenue and capital expenditures all allowed except for land and building. We all know, thank God it is written here, no capital allowances on land and building. You this is a these are very famous lines. No capital allowances on land and building. Even you in your capital allowances chapter, it's not allowed. So same here. Here revenue and capital expenditures are all allowed. Means if you do revenue, if you pay electricity bill, it's allowed here. And if you buy plant and machinery, immediately that plant and machinery will be allowed. Immediately that plant and complete amount of that plant and machinery will be allowed. Means, see, means no capital allowance chapter is needed in this topic. We don't have to calculate any capital allowance like tax allowable depreciation, because tax in this chapter, cash basis tax authority immediately allows all capital expenditures as well. Okay, so only inflows and outflows, only inflows and outflows. See, what does it mean? When we buy plant, we deduct complete cost, and when we sell the plant, we add it receipts. That's it. That means cash coming and cash going. That's it. Now one very important line for this. In normal accrual basis topic, accrual basis means the existing trading income which we studied. Accrual basis means the last trading income topic which we studied. When you buy a car, listen, in normal trading income chapter, I'm not talking about cash basis right now. In normal trading income chapter, when you buy a car, not only you get capital allowance. See, we have just studied the CO2 emission rates. You get capital allowance on the basis of CO2 emission rate, but also the running cost of that car is also allowed. I repeat, in normal trading income chapter, when you buy a car, not only you get capital allowance according to CO2 emission rate of that car, but also you are allowed the running expenses of that car. Okay, if that car is used for business purpose. But now in cash basis, open your eyes, important dialogue. In cash basis, no actual, if you buy a car, this outflow is not allowed. Not original cost of car is allowed. No original cost of car is allowed. No running expenses, nothing. Look at me, nothing related to car is allowed except for mileage allowance. Except for mileage allowance. And we all know mileage allowances is calculated. Mileage allowance is calculated on business miles, strictly business miles. Mileage allowance is calculated on business miles. Hope you remember, 0 to 10,000, 45 pence per mile, and then 25 pence per mile. Okay, So be careful. There are questions in your kit as well. There are questions in your kit as well. Okay. Now, a very quick short recap of partnership. Then after this, we'll shift on the software. Okay, we'll be doing software thing. First of all, in partnership question, first of all, partnership. Look at me. Partnership normally don't pay any tax. It's sole traders who pay. It's partners, owners who pay their tax separately. I repeat, partnership firm don't pay any tax. It's sole traders, it partners, they pay their tax separately as a sole trader. So what's the science? Listen, you have the combined profit of partnership, you have the combined total profit of partnership, and then that profit you have to apportion, you have to do apportion, and you have to do appropriation of profits, so that each and individual ABC, for example, three partners, each and individual partner share you can calculate, each individual partner share you can calculate, and that partner will be treated as a sole trader, and he will pay his tax separately. He will pay his tax separately. Okay. Now look at here. What may come in partnership questions? What may come in partnership question? Please be very active. You will learn some good things. First of all, a very big question, a detailed question. Let's assume a big question. See, accounting P&L, accounting net profit will always be given ready-made, because you are not no more. This is not accounting paper. So accounting P&L will be given to you ready-made, and this accounting net profit will be ready-made given to you. So the first journey, the journey number one, you will write accounting net profit, and you will convert it into tax adjusted trading profit. How you will convert accounting net profit into tax adjusted trading profit? I hope you remember, I taught you the journey today. Add back all those expenses which are allowed in accounting, not allowed in tax, less capital allowances. Oh, you remember all the adjustments. So the first journey which you may have to do, which you may have to cover, is the journey from accounting net profit to tax adjusted trading profit. Accounting net profit to tax adjusted trading profit. Okay. Now once you get tax adjusted trading profit, once you get tax adjusted trading profit, you start this thing. See, appropriation of profits, you start this thing. See, once you get tax adjusted trading profit, you start appropriation of profits. And appropriation of profit is very simple thing. 99% students have done this in their accounting paper as well. how we do how we do this this appropriation. First of all, if salaries of partners are given, you have to remove, you have to deduct. If there any interest on capital is given, you have to deduct. If there is any interest on drawing is given, you have to add, because interest on drawing, partners pay to firm, partners pay this interest on drawing to firm. Okay. So then finally you will get residual profit. Assuming there are two partners A and B, assuming there are two partners A and B, then, and the profit sharing ratio in my example is 60/40, so you'll divide. Okay. So two two things we have just studied. Number one, the journey of one thing may come, the journey from accounting net profit to tax adjusted trading profit. And once you calculate tax adjusted trading profit, then you can easily do appropriation of profits. Okay. Okay. Done. One thing I can add here, you know, it happens sometime, and there are questions in the kit as well, that during there may be changes in partnership agreement. like mid of the year a new partner is entering or one existing partner is leaving. So you must know this, when one partner enters in the partnership or existing partner leaves the partnership, the existing agreement of partnership becomes null and void, and they have to do a new agreement. So for example, in your accounting period, first 6 months the profit sharing ratios are different, the agreement is different, and last 6 months the profit sharing ratio and agreement is different. So in that case you have to do separate appropriation for first 6 months and last 6 months. Okay, that's not difficult, but you have to do first 6 months and last 6 months, sometime first 3 months and last 9 months, okay, accordingly. Now once you have done with appropriation, now read the lines. Total profit share of each partner. Now you have to calculate total profit share of each partner. What partner is getting from the firm? See, partner may get salary, add this. Partner may get interest on capital, add this. Partner may sometimes gives back interest on drawing to firm, so deduct it. And partner may get residual profit, add this. You have to make this packet for each and every partner, for A, B, and C separately. If there are three partners A, B, and C, you have to make this profit, this packet for each and every partner. Now a very turning point, this final number is trading profit. Okay, this final number is trading income for each partner. This final number is trading income for each partner. Why? Because people do partnership for business. Have you ever heard that somebody saying we are doing job in partnership? We are doing job in partnership. Never. Partnership is for business. Partnership is for business. Okay, so whatever you are earning from partnership is your trading income. Whatever you are earning from partnership is your trading income. So the total of this packet is your trading profit. The total of this packet is your trading profit. Okay, now I'm adding one more topic in it, but we'll give you a slight intro of that topic, no more depth, sorry, because we have to do the questions. Read the lines. Now read. Now if a partner, read the red marker lines, please my dear students, little energy is required. Now if a partner has just admitted in partnership, then it's start of business for that partner. So we'll apply opening year rules. I hope you remember basis period rules. When a partner joins the partnership, so for that partner it's beginning of business. For that partner it's beginning of business. And you know, sometimes for beginning of business you have to apply opening year rules of basis period. Similarly, if a partner has just retired, if a partner has just left the partnership, that means for that partnership this is end of business. For that means for that partner it's end of business. So you have to apply closing year rules. You have to apply closing year rules, basis period rules for that partner. Okay, don't forget. All of you, I expect all of you have studied a normal course as well, and in the normal course teachers normally discuss this issue. Now I have already told you this. Partnership firm does not pay any tax. Each partner pays its own tax as a sole trader. Each partner pays its own tax as a sole trader. Okay, no more tax payment by partnership firm. So we divide the profit, we divide that profit to each and every partner, and each partner will be treated as a sole trader. Each partner will be treated as a sole trader. Okay, right? Now one more thing. I hope you remember the trading income chapter. You know, owners in trading income chapter. Today we discussed in trading income chapter, owners' personal expenses are never allowed. Owners' salary, owners' interest on capital. You have studied in trading income list. Trading owners' personal expenses are not allowed. Drawings, owners' salary are not never allowed. Now, similarly, partners are also owners. Partners are also owners. That's why partner's salary and interest on capital are not an allowed not an allowed expense from trading income P&L. From trading income P&L, don't forget, from trading income P&L, it's not allowed at all. From trading income P&L, it's not allowed at all, strictly not allowed. Okay, in your kit I think there is a question A, B, C, like I forgot the name. In that question they have allowed, in that question, in the accounting trading P&L, accountant has already deducted the partner's salary from the P&L. Accountant has already deducted the partner's salary from the P&L, so you have to add it back. You have to add it back because partners are owners, my dear student. Partners are owners, and owners personal expenses, owners salaries are not allowed. Yes, one thing is allowed: owner's family members. If owner's daughter, owner's wife, family members are doing job, then normal salaries are allowed, but excessive salary is not allowed. But excessive salary is not allowed. But excessive salary is not allowed. Okay. Okay, got it. Now one more thing with partnership, sometime if you get a big question of partnership, complete question of partnership in your exams, so you might have to do capital allowances working in partnership question as well. So it's very common that partners are owners and they are human beings, owners plus human beings. Okay, so in that case sometimes partners do private use of the car, so you have to make rights, you have to depool those cars, you have to depool those cars. Okay, right. Now from here we are moving to the software, and we'll solve the question on software. And believe me, it's very easy. It's just you must know a little bit typing, you must know a little bit timing. It's not advanced Excel or something, very basic thing, and we'll go slow with you. Okay, now as I want you to see the full screen, I want to see the full screen of software because the question will also be written on that. So I'm closing my switching off my camera, right? Okay, I have also sent you the question. I've also sent you the question on WhatsApp. The name of that question is Petula. The name of the question is Petula. It's in front of you. It's in front of you. Can you see? The Petula question is in front of you. See, Petula is a sales manager by Downtown PLC. He has given the following benefits which are subject to tax. Following the details, you are required to read the details carefully and answer the requirement. I would suggest you one thing. Listen, keep a pen and paper with you. Sometimes I'll give you some tips so that you can write it, so it will be easier for you to understand that topic. Okay, so keep a pen and paper with you. I will give you some hints, right? Now we are going to click the details of that employment income. See, now first of all, this question, what's the theme of this question? This question contains some part of employment income. This question contains some part of employment income, some part of property income, a little bit of pensions, right? And a little bit of interest income guilds, right? So if you know basic knowledge of these topics, you can easily do it. Okay, first of all, let's read it. Keep a pen and paper with you so that you can take the points. I hope you can see the question. Now, Petula has been employed as a sales manager by Downtown PLC since 6th April 2011. He doing job for many years. Okay, the following information is available in respect of the tax year 2019-20, right? Okay, now point number one, this is the beginning points are for employment income. The beginning points are for employment income. Okay, now number one, during the tax year 1920, Petula was paid a gross annual salary of 2,30,000. Easy scoring point. See, earning from employment is the first cash salary employment income. This 230,000 will simply be added in employment income PNL. This 230,000 will simply be added in employment income PNL, and we have also done the employment income PNL today. I showed you, right? Okay, so this salary will simply be taken in the employment income PNL added. We'll do it, don't worry. The second point, in addition to her salary, Petula has been paid the following. Petula has been paid the following bonuses by Downtown PLC. Now, for bonus, as she's not a director, normal employee. So for normal employee, very simple rules for bonus. Just write the two dates. Just simply write the two dates. Number one, entitlement date. When you are entitled for that bonus, and number two, the receipt date, when you actually receive that bonus. Just simply write the two dates. Number one, entitlement date, and number two is receipt date. Okay, and whatever date is earliest date, and that date, check that date in which fiscal year it lies. You have to pay tax on the bonus on the same fiscal year, right? So just two dates and earliest, okay. Now let's read it. In addition to her salary, Petula has been paid the following bonuses by Downtown PLC. See, the first bonus, the amount of first bonus is 21,200. Now, my dear student, be active. Date of payment is 30th April 19, but date of entitlement is 1st April 19. Wait, out of these two dates, which is earlier? 30th April 19 and 1st April 19. Which date is earlier? The earlier date is 1st April 19. Now use your brain. 1st April 19 does not fall in 1920 fiscal year, because 1920 fiscal year starts on 6th April. Because 1920 fiscal year starts on 6th April 2019. 6th April 2019. So my dear student, this first bonus belongs to last fiscal year. Simply ignore it. Now one more thing, you may ask, sir, there is one more heading in respect of the 6 months. This is irrelevant. Only two dates are relevant, that are receipt date and entitlement date. So the first bonus of 21,200, the earliest date falls in the previous fiscal year, so no need to include in our fiscal year. And don't forget, our fiscal year is 1920 fiscal year. Don't forget, our fiscal year is 1920 fiscal year. So let's ignore the first bonus. Now, second bonus, 18,600. The amount of second bonus is 18,600. The date of payment for this bonus is 31st October 2019. 31st October 2019, and the date of entitlement is 1st October 2019. Very simple, my dear student. What is the earliest date? The earliest date here is 1st of October 2019, and obviously we can easily judge that this 1st October 2019 falls in 1920 fiscal year. 1920 fiscal year. Yes, this bonus is relevant for us. Okay, now next, the last bonus. Payment date is 30th April 2020, but entitlement date is 1st April 2020. Come on, use your brain. Which date is earlier? The earlier date is 1st April 2020. And yes, 1st April 2020 lies in our fiscal year. 1st April 2020 lies in our fiscal year. So definitely we have to include this bonus. So in point number 2, the bonus area, which two bonuses are relevant, dear students? The second and third, 18,600 and 22,400 Okay, so we have just discussed 2 points. The point number 1 is salary, which is very cash marks, and point number 2, bonus, again not difficult at all. Now for point number 3, there is a very little dodge, not big dodge, little dodge. You might have studied mileage allowance. What is mileage allowance? Mileage allowance means sometimes employee uses his own car for the business of employer. Sometimes employee uses his own car for the business of employer, and In return for this driving, employer pays certain amount to employee. Employer pays certain amount to employee. Now look at the screen carefully. Whatever, first thing, whatever employee is receiving, whatever employee is receiving from employer for this driving, this amount is full-time taxable. This amount is full-time taxable. Just assume it. You have to add it. You have to add it. You have to add whatever amount, whatever total amount you are receiving from your employer, you have to add. You have to add in your employment income P&L. But one thing is allowed. One thing is allowable deduction, and that is mileage allowance. That is mileage allowance. But be very careful. I I repeat it, and I will emphasize those words. Listen, mileage allowance is only computed for business miles. Mileage allowance is only calculated on business miles, not private miles. But whatever you have received from your employer, that total amount will be added in employment income. Okay, so one thing is added and one thing will be subtracted. What will be added? Whatever you have received from your employer for this driving. And what will be subtracted? The mileage allowance will be subtracted. But mileage allowance is strictly computed on business miles. Okay, let's read it now. During the year 1920, Petulia used her private motor car for both private and business journeys. The total mileage driven by Petulia throughout the tax year was 26,000 miles. Keep it in mind, 26,000 miles. With all, see the word all of this mileage reimbursed by Downtown. Downtown PLC is the owner at the rate of 60 pence per mile. Okay, use your pen and paper, write it. How much amount you must have received? How, as an employee, how much amount you must have received? 26,000. 26,000 times 26,000 times 0.6. 26,000 times 0.6 you must have received. Okay, so this amount will be added because you have received from your employer. Now let's calculate the mileage allowance, but strictly mileage allowance is calculated on business miles. Next line. However, only 21,000 miles were in the performance of Petulia's duties. See, performance of duties means business miles. Okay, so we are going to calculate only mileage allowance for these 21,000 miles. Sir, how do we calculate? These are fixed rates. Definitely, it will be given to you in the exams, or you can learn it as well. For first 10,000 miles, it's 45 pence per mile. Okay, and the excess 11,000 miles will be calculated using 0.25 per miles. Okay, 25 pence. So it's very easy, right? So point number 3 is also related to employment income. Point 1, 2 and 3, all of them related to employment income. You can see it. I'm giving you 30 seconds. You can see it. Now the fourth point. Wait. I hope you remember today's lecture. When I started today's class, very first thing I taught you employment income. And in employment income, I taught you certain identifications. Wait, in employment income, there are two major things. Listen my words. In employment income, there are two major things. One is benefit and one is deduction. One is benefit, one is deduction. One is benefit, one is. What is the identification of benefit? The identification of benefit is what you as an employee receive from your owner, from your employer. What you as an employee receive from your owner is benefit. And what is deduction? Deduction is the amount what you pay from your pocket. So normally deductions are those amount which employee pays from his own pocket, or whose burden is borne by employee. So now use that identification technique and read the point number 4. First of all, you have to identify that point number 4 is a benefit or deduction. Point number 4 is a benefit or deduction. Come on, read it. It's written. Petula pays, Petula pays, Petula pays, Petula pays. Petula is employee, Petula is employee. So when employee is paying, that means it's deduction. When employee is paying, that means it's deduction. So I hope you remember there are two types of deductions. Number one is allowed and number two is not allowed. Some deductions are allowed and some deductions are not allowed. Okay, let's read it. You will quickly recognize it, I'm sure. Okay, now Petula pays an annual professional subscription of £630, which is relevant to her employment with Downtown PLC. Yes, this is full-time allowed, like your ACCA subscription fees, CFA subscription fees, ICAW subscription fees, because these subscription fees are connected to your job, because you normally get your job because of these qualifications. Okay, so yes, this is totally allowed expense and I'm going to deduct it soon. Number two, open your eyes, this is a dodge. Petula also pays, again it's a deduction. Again it's deduction because the money is going out of the pocket of employee. Petula also pays an annual subscription membership fee of 1840 to a golf club which she uses to entertain Downtown PLC's clients. Downtown PLC does not reimburses Petula for either of these costs. Now wait, Petula has taken a golf club membership and she's paying with her own pockets. Obviously, it's deduction. Now I'm asking a question. You can reply in the chat box. Is this deduction is allowed or not? Is this deduction is allowed or not? The answer is no. Big no. Big no. Why? Because I told you there is a duality. There is a duality in it, because when she goes to golf club, maybe possible she might get clients from there, but she will also get some private benefits, the recreational benefit. So there is a private element is added in it. There is a private element is added in it and there is a duality in it. That's why tax department strictly does not allow such cost. Okay, so this thing is not allowed, this thing is not allowed at all, this thing is not allowed at all. Okay, so point number 1, 2, 3 and 4, point number 1, 2, 3 and 4 is totally related to employment income. Now I'm going to show you how we have to solve it. Okay, we are solving the first point, the first 4 points of employment income. See, I'm going to open the spreadsheet. I'm going to open the spreadsheet. You can see the spreadsheet. You can see the spreadsheet. First of all, we are going to calculate employment income. Now, for employment income, what's the first thing which we have to add? Salary. See, these are all very simple things, normal, very normal and ordinary level typings. So the salary is 2,30,000. See, I've just written. I hope you can see it. Then the second thing is bonus. Second thing is bonus. Okay. Now we just did. There were total three bonuses. The first bonus was irrelevant, but the second and third bonus was relevant. Okay, the second and third bonus was relevant. See, I have adjusted the columns, and I'm applying the formula of addition. See, there are two bonus, 18,600 plus 22,400. So see, I have added both of them. One more thing you can do, this thing on calculator as well. You can do this thing on calculator and write the number 41,000. So the first thing is salary and the second is bonus. Now the third thing is amount received and mileage allowance. Now be very active. For amount received, we have to do first working. See, for amount received we have to do first working. I have done bolded, okay, so that examiner can easily see it. On the first day I told you some exam techniques. Now, how much reimbursement, how much amount you received from your employer? You drove 26,000 miles, and per mile you received 0.6. per mile you receive 0.6. So this is 26,000 multiplied by 0.6 will give you 15,600. See, I've used the formula 26,000 into 0.6 and this complete amount is taxable. Now, what amount will be allowed expense? Mileage allowance. Mileage allowance will be allowed expense. That's we call it tax-free amount. Mileage allowance, and mileage allowance is only calculated on business miles. Mileage allowance is only calculated on business miles. So my dear student, you have the question I have already sent you. For business miles, the first 10,000 miles we get 0.45, and then the additional miles we get 0.25. See, on the first 10,000 miles I have applied 45 pence, and for the other miles I have applied 25 pence. Okay, so 15,600 is the amount received less these two. 15,600 is the amount received less these two. Okay, right? 4,500 and 2,750. 4,500 and 2,750 is the mileage allowance. 15,600 is the amount received. One more thing you can do. Listen, I have used the formula with minus sign. If you are already writing this tax-free amount with negative sign, so you can simply apply the you can simply apply the sum formula and you will get the right answer. Okay, both options are okay. Either apply minus sign in the formula or apply minus sign in the cell, both will give you the same answer. Now let's connect it. I have connected 8350 in the main sheet. See, I have connected 8350 in the main sheet, right? Now, three things we have already done. Salary, the first thing, bonus, the second thing, the third thing is mileage allowance. Now, fourth one was deduction. Fourth one was deduction. I think it was professional fees. Fourth one was deduction. I think it was professional fees. One more point which I just want to highlight. You can go to the question. Go to the question. One more point I want to highlight, that is employer contribution. Employer contribution in occupational pension scheme. Employer contribution in occupational pension scheme. Read the point number. Read the point number 6. Read the point number 6. Can you see the point number 6? Each tax year, point number 6 of the question, please. Each tax year since 6th April 2011, each tax year since 6th April 2011, including the tax year 1920, that means our own fiscal year. See, each tax year since 6th April 2011, last nine years almost, including our current year. Downtown PLC means employer. Downtown PLC means employer has contributed 30,000 in the company's HM Revenue Customs registered money purchase occupational pension scheme on Petula's behalf. Now hold. I hope you remember the rules of exempt benefit. If employer is paying, if employer is contributing in employees pension scheme, then this is a benefit. Yes, it's a benefit, but this is totally exempt benefit. This is totally exempt benefit. This is purely exempt benefit. Now the question is how we have to deal with exempt benefit. Just write 0 for exempt benefit. Just write 0 for exempt benefit. Just write 0. Okay, in this way you will score 0.5 marks or something. Okay, now the question is, sir, there are many things, other things also written in this paragraph. Leave it. This is connected to requirement number 2. Right now it's not relevant. Right now for employment income, this 30,000 is exempt benefit. For employment income point of view, this 30,000 is totally exempt benefit, and we'll write the 0. Okay, let's move to the spreadsheet. Let me enlarge it. Now the fourth thing is employer pension contribution in employee benefit. It's 0. Okay, because this is exempt benefit. For exempt benefit you just have to write 0. Now Point number four, which we have already read, you have seen. For point number four, professional subscription fees. Professional subscription fees of 630 is an allowed expense, but the second contribution, golf club membership fees, is not allowed because of duality. Golf club membership fees is not allowed because of duality. Okay, so here you have total employment income. Here you have total employment income. Just simply applied the sum formula. Simply applied the sum formula in it. Okay, so here you have your employment income. See, I've just done employment income. Okay, so okay, wait, it's azan time. Just 30 seconds, wait.
चाहिए ऑफिस में बैठे हैं आप सब चाबी ऑफिस में सर जी जी
Okay, students, we are taking 6 to 7 minutes namaz break, and then we'll start this topic. Okay, we have calculated employment income. You can see the employment income. The remaining part we'll be doing after namaz. Okay, 6 to 7 minutes namaz break. Okay, Assalamu alaikum. We are starting the class again. Now, we have just calculated the employment income. But in this question, there are more things as well, like property income and like some other information as well. Okay, so let's move to the question. You have the copy of the question. If you have exam kit, you can see in the exam kit as well. I've also sent you this question on I've also sent you this question on WhatsApp, so you can see anywhere or in the screen is it's also visible. Okay, so now point number five. Point number five. Listen, point number five, I must say, is a general point. This point is not related to any specific P&L, not for trading income, not for employment income, not for property income. This point is related to the three columns. Hope you remember the non-saving interest dividend. Hope you remember the non-saving NS interest dividend, NS interest and dividend, the three columns game. Hope you remember. So there are one thing which directly goes in that column, and that is qualifying interest. Day one I taught you, on the day one of revision days I taught you qualifying interest. But what is qualifying interest? If you have taken loan for qualifying purpose, then that interest will be treated as qualifying interest. And hope you remember, one of the qualifying purpose is if an individual has taken loan for the purpose of employment. If an individual has taken loan to buy an asset for employment, to buy a property, plant and equipment for employment use. Let's read it. Let's read it. Point number five, sorry. During 1920, during 1920, Petula paid interest of 140 on a personal loan taken out on 6th April 2008 to purchase a computer for sole use in her employment with Downtown PLC. See, openly, it's openly clear cut. It has written that she has taken loan to buy the asset for employment use. Okay, so this is qualifying interest. But now there is one dodge. They have taken loan in 2018. So why you are deducting the interest now? Because for qualifying interest, the basis is cash basis. The basis is cash basis. Whatever interest you have paid in your fiscal year, you just have to deduct. Okay, so this point number five does not relate to any specific P&L, not for employment income, not for trading income, not for property income. This point number five will go in that column, non-saving interest dividend working, that income tax computation sheet. Okay, income tax computation sheet. Okay, now my dear students, we are moving to the property income area, which is very easy. Now, first of all, property income for individuals, property income basis of assessment is cash basis. According to new rules, last 2 3 years, for individuals, property income basis of assessment is cash basis. Cash basis means pure cash incoming and cash outgoing. Cash incoming and cash outgoing. Let's read this first paragraph of point number 7. Okay, now Petula owns a freehold house which was let out furnished throughout the tax year 1920. The amount of rent received cash basis received during the tax year was 12,000. Okay, so in simple terms, this is your rental income, and obviously it is received. That's why we'll simply add in rental income side. This is your ready-made rental income, which is very easy. Now hold. Next paragraph. I hope you have studied. I haven't taught you this. I haven't taught you this in my revision days, but right now I can recall. I hope you have studied that when you give your property on rent, so there are certain furnitures in your property. Okay, so the rules are, listen, capital expenditures are strictly not allowed. Capital expenditures are strictly not allowed. Second rule. If you buy an asset for the first time, wait, let me recall again. Capital expenditures are not allowed, and capital expenditure equals improvement. So if you buy an asset, a furniture, for the first time in your house, So some new thing, an additional thing is coming in your house, so it's improvement. So first time buying of any asset, it's strictly not allowed. You buy any asset for the first time, it's strictly not allowed. Total pure capital expenditure, ignore it. But yes, let us say you bought a furniture now, but after 2 years you replace it. Now at the time of replacement, some amount will be allowed. What amount? If you buy the replacement asset of same quality, listen to me very carefully. If you buy the replacement asset of same quality, sometimes they use the word equivalent cost, then that equivalent cost will be allowed expense. Okay, but if you buy an improved version, then extra, over and above of that equivalent cost, extra amount will strictly not be allowed. So in short, the summary is again: first time you buy an asset, strictly not allowed. But at the time of replacement, only equivalent cost is allowed. Only equivalent cost, or the second word, you can say the same quality product is allowed. Over and above is strictly not allowed. Let me read the paragraph. Okay. During August 2019, see the fiscal year, Petula purchased a new washer dryer for the property at a cost of 730. Read the lines. This was a replacement. Yes, some amount may be allowed now. Some amount you can get some relief. This was a replacement for an old washing machine which was scrapped with nil proceeds. See, no proceed is given. That's a good news for you. The cost of a similar washing machine would have been 420. I just told you the equivalent cost or similar quality amount is allowed. So in this replacement, only 420 is allowed. Now one more thing student may ask, sir, what if right now it's written nil proceed? What if it is written that scrap proceed is 50? Then you need to deduct 50 from 420. Then you need to deduct 50 from 420, and then 370 will be allowed. But right now the proceeds are nil. So my dear student, 420 is simply allowed. Now next para. During November 2019, Petula purchased a new dishwasher for the property at a cost of 580. The property, see the king line, the property did not previously have a dishwasher. That means they are buying the dishwasher for the very first time. They are buying the dishwasher for the very first time. They are buying the dishwasher for the very first time, so it's not allowed, strictly not allowed. Okay, so in this paragraph only 420 is allowed, only 420 is allowed. Now next line, the other expenditure on the property for the tax year 1920 amounted to 1640, and all of this is allowable openly. They are saying it's allowed, so it's allowed. Okay, so now in point number 7, what is your rental income? 12,000 will be added as a rental income. And what's the allowed expenses? 420 and 1640. 420 and 1640. 420 and 1640. Now point number 8. Point number 8 is again related to property income, and I'm sure, I'm 100% sure you all have studied a relief, rent a room relief. First of all, let me recall the conditions of this relief. For example, first of all, the house is occupied by owner, means owner, the landlord is living himself in that house, and he or she has rented out one room or few rooms. Like in UK, normally people give their one room or two rooms to students. That's very common because UK is one of the education hub, one of the biggest education hub, right? So owner, landlord is living in the house is occupied by landlord as well, plus one room or few rooms have been let out. And the third condition, that these rooms are furnished. In that case rent a room relief will be applied. Now how to apply rent a room relief? Number one, first of all, actual rental income of that house will be given and actual expenses will be given. First of all, you will be doing actual working. And the second working is what we call relief working. In relief working, you will be using actual rental income. And in relief working, you have to ignore actual expenses. Just 7500 fixed you can deduct. Ignore actual expenses, just 7500 you can deduct. And then you have to decide which one is beneficial, which one is beneficial. Let's read it. It's a game of seconds. I must say this is a game of seconds. Now, one bad news: examiner never uses the word rent a room relief in the question. You have to identify through conditions. I repeat, examiner never uses the word rent a room relief in the question. You have to identify through the conditions. Okay, let me read it. It is written: during the tax year 1920, Petula rented out one furnished room and furnished of her main residence. That's it. This one line is enough for me. Main residence means occupied by owner, one room let out, and that room is furnished. Okay. During the year, she received rent of 8900 and incurred allowable expenditure of 2890 in respect of the room. Petula always uses the most favorable basis as regard the treatment of the furnished room. Come on, dear students, you can also write in the chat box what should I do. It's ready made. It's this is called what we call cash marks. Which one is beneficial? Actual expenses of 2890 is beneficial. Actual expenses of 2890 is beneficial, or 7500 relief is beneficial. Obviously 7500 relief is beneficial. So if you deduct 7500 from 8900, the answer will be simply 1400. Answer will be simply 1400. Okay, right? For this we have to do a short working. Let's let's go to the spreadsheet. Now see the working. This is very simple. Now we are working on property income. Now we are working on property income. See, working twos, you can see the working two. First of all, we'll write the rent received. Very simple. Rent received 12,000. Now at the time of replacement, I think 420 was allowed. 420 was allowed. Hope you remember. 420 was allowed. But the dishwasher was not allowed because the dishwasher we bought first time. Dishwasher we bought first time. Also, other expenditure was I think 1640. Other expenditure was 1640. So the first working is ready. See, I am applying some formula. 9940. 9940. Now for rent a room relief, you tell me which one is beneficial. Which one is beneficial? Obviously claiming relief is very beneficial. So 8900 minus 7500 will be your taxable thing. Okay, so your total property, final property taxable income is 11340. Final property taxable income is 11340. See, and now this property income will take to the main format. See, just pick that cell and you can connect it. Okay, so you have two things we have done. Property income is done and employment income is done. Property income is done and employment income is done. Okay, now I hope you remember my first class. I taught you There are some incomes for which you have to make P&L, like trading income. Yes, you have to make P&L. Property income, there is a P&L. Open your eyes. And employment income, there is a P&L. But for interest and dividend income, no P&L. Interest and dividend incomes are normally picked directly from the question, and they are just copy pasted to the main format. They are just copy pasted to the main format. Now, point number 9 again is a new thing. It has been added last 2-3 years back. I hope you remember interest on guilds. Interest on guilds. Now, just listen to me very carefully. Guilds, or we can say government securities, are exempt for CGT purpose. Are exempt for CGT purpose. So, whenever the first point, please active. Whenever you see a guilds question, the buying price and selling price is totally irrelevant. Whatever price you are paying to buy that guilds and whatever price you are paying to sell that guilds, that's totally irrelevant because it is exempt for CGT. So no more capital gain or capital loss you have to calculate. For guilds, you are not required, you are not supposed to calculate capital gain or capital loss. So buying price and selling price is totally irrelevant. Only one thing is relevant. Open your eyes. Just just calculate your period of ownership. Means how many months you own that loan notes. How many months you are with that loan notes. You have to book interest. You are responsible for paying tax for that interest income. That's it. And how we calculate interest income? Listen my words. Nominal value of loan. Nominal value of loan multiplied by coupon rate. Nominal value of loan multiplied by coupon rate multiplied by your months. Multiply by your months. Last time I'm repeating. Buying price and selling price of guilds is totally irrelevant because it is exempt for CGT. Ignore it. Buying price and selling price. Just you are responsible for paying interest income tax. We are just responsible for paying interest income tax of this guilds and for our period of ownership. So just calculate the number of months in which we own this loan notes or this guilds, and simply calculate the interest income. Sir, how to calculate the interest income on guilds? Listen carefully. Just pick up the nominal value or face value. Both words are correct. Nominal value or face value of that loan, multiply by coupon rate, yearly coupon rate, multiply by number of months of your ownership. That's it. And you will get the interest income. You will get the ready-made interest income. Let's read it. On 1st July 2019, this is in between your fiscal year, right? Petula purchased 250,000 nominal value. Yes, nominal value is relevant. Nominal value is relevant. Of guilds paying interest at the rate of 3%. Yes, this physical interest, nominal interest is also important. For 300,000, irrelevant. The amount you just paid for buying this loan note, it's totally irrelevant because no more capital gains. 300,000 is irrelevant. Interest paid half yearly on 30th June and 31st December based on the nominal value. See, they have given the hint. Petula sold the guilds on 31st October 19 for 302 500 including accrued interest. Now the selling price is again irrelevant. Ignore it, throw it out. Only just count your months. Come on, Petula bought it on 1st July and she sold it on 31st October. So my dear student, the months are July, August, September and October. She owned only for 4 months. So 4 months, for 4 months interest income, for 4 months interest income, Petula is responsible. For 4 months interest income, Petula is responsible. Okay. So how we'll calculate? Now wait, sir, do we have to make a PNL? No, never. For interest income, there is no PNL. You simply write in the text computation sheet. Okay, let's go to the text computation sheet. See the working, please. See, this is 4 upon 12 because 4 months. So 250,000, see the formula, times 3%, or we can write 0.03. For 3%, we can write 0.03 times 4 upon 12. Okay, so this is your interest income. Now we have done everything. Now read the requirement of the question. All of you, you have the requirement of the question, and the requirement of question is calculate petty loss taxable income. 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 You know what is taxable income? Taxable income means after deducting personal allowance. After deducting personal allowance. Now we are forgetting one thing. Hope you remember. We have added all the incomes. Look at here, we have added all the income. From the total income we deduct qualifying interest. Read the point number 5. There is a qualifying interest of 140. There is a qualifying interest, I hope you remember. There is a qualifying interest of 140 that needs to be subtracted from total income. There is a qualifying interest of 140 that needs to be subtracted from total income. Okay, so here you have net income. When you deduct qualifying interest from total income, you get net income. Now a very quick thing I'm going to tell you, you are no more kids. Net incomes we take on the side for the side working to calculate ANI. As there is no qualifying, as there is no gifted donations, and no gross PPC. In this question there is no gift aid donations and there is no gross PPC. That's why your net income and your ANI is same thing. So your ANI is 292420. Your ANI is 292420. That's why your personal allowance will be zero. As your ANI is greater than 1,25,000. Day one I taught you. As your ANI is greater than 1,25,000, that's why you are not eligible for any personal allowance. Your personal allowance is zero. And when your personal allowance is zero, look at me, then definitely your net income is equal to taxable income. So you have taxable income of 292,420. So you can see this is not an abnormal work a normal man can do. It's just need practice. But yes, in the examiner reports it is openly clearly written that you should practice the last 40 marks in in software, right? So if you keep working on the software, it will be used to. Or I must say, this is the technology. So technology is more time saving. Just you need to increase a little bit your typing speed, little bit of your typing speed, nothing else. Little bit of your typing speed, nothing else. Okay, so your first requirement done. There is one more requirement, but as we are running short of time, I will give you just oral discussion for this. Okay, because we have to do one more question. And we are running short of time, so I will just give you oral things, but you must know the pension rules. Come to the point number 6. And use your brain. Come to point number 6 and use your brain. Okay, point number 6, I'm starting point number 6. Boys and girls, please active. It's written, each tax year since 6th April 2011, including the tax year 1920, Downtown PLC has contributed 30,000 in the company's HM Revenue and Customs registered money purchase occupational pension scheme on Petula's behalf. Petula has never personally made any pension contribution, and her adjusted income in all tax year prior to 1920 never exceeded 150,000. Now wait, I hope this is something totally new for you if you haven't studied pension, but I can just tell you the solution right now. Look at here. There is one thing which we call it adjusted income, not ANI, it's AI. It's AI. And I hope you remember the rules. If your AI is 150,000 and less, then your annual allowance is 40,000. When your AI adjusted income is in between 150,000 and 210,000, then gradually your annual allowance reduces. And if and if your AI annual adjusted income, if your AI is greater than 210,000, then you are eligible for only 10,000 annual allowance in that fiscal year. Okay, these are the rules for AI. In your pension chapter you studied this. In your pension chapter you studied this. Now just think, first go to the last 3 years. We are in 1920. In last 3 years you will be allowed, you will have 40,000 annual allowance, but you used your annual allowance 30,000 every year. Just think, because every year your employer contributed 30,000, your employer contributed 30,000 every year, so that means you have taken 30,000 relief every year, but your annual allowance in previous years were 40,000. So that means since last 3 years you have unused annual allowance of 10, 10, and 10. Since last 3 years you have unused annual allowances of 10, 10, and 10. That means 30,000 brought forward. Be active. 30,000 annual allowance brought forward since last 3 years. Just think over it. But unfortunately, see the question solution of this question. Unfortunately, your this year AI is 292 something. Your this year AI is 292 or 3 lakh plus. 292 or 3 lakh plus, it's too much. Your this year adjusted income is 3 lakh plus. So when it is 3 lakh plus, that means it's greater than 210,000. Your 1920 adjusted income is greater than 210,000. So for 1920, specifically 1920, your annual allowance is only 10,000. Only 10,000. Now use your brain. For 1920 you have annual allowance of 10,000, and how much brought forward you have? 30,000. That means total annual allowance you have of 40,000. 10,000 current year, and from previous 3 years you have 30,000. So 10 plus 30, your annual allowance is 40,000. Now think, in 1920 your employer contributed 30,000 in your pension account and you got relief for this. So you have 40,000 annual allowance, and you got the relief for 30,000. So still you have unused annual allowance of 10,000, and that will be carried forward next year. Still you have unused annual allowance of 10,000, and that will be carried forward next year. That's all you have to write in this requirement. That's all you have to write in this requirement. Okay, now let's move on the next question, because our target was 2 questions today. The second question I have chosen was a planning question. Very good question. I hope you remember my example of school and teacher. I taught you that a teacher in school a teacher may have two setups. The first, the teacher may be called as an employee, and the second, the teacher may be called as self-employed. If teacher is a full-time worker with fixed salary, with control by employer, right? What to do, how to do, everything is told by employer, then that teacher is treated as employee. But look at me. But if the teacher is visiting faculty, his timings are not fixed. His his uh, he he's getting share of the profits, he's getting receipts. So in that case he's sharing the risk. So now this teacher is self-employed, or what we call businessman. Now his income will be treated as trading income. Okay, so I have sent you the question. The next question for today's class is Carol Courier. The next question for today's class is Carol Courier. The next question for today's class is Carol Courier. Please be active. Okay, can you see this? Now, students, whatever story whatever story I told you for teacher and school, the same story they have given you as a driver, the same story they have given you as a driver. Okay, so first of all I'll do the employment income part. Now let's, for the purpose of this question, you should assume that today's date is 15th of March 2019. Now, Carol Courier is employed by Quick Speed PLC as a delivery driver and is paid a salary. See, the salary means he's employed. 44,000 per year. She contributes, she means employee, employee contributes 5% of her gross salary, 5% of her gross salary into Quick Speed PLC HM Revenue and Customs registered occupational pension scheme. I hope you remember the rules. If employee is contributing in occupational pension scheme, then it's an allowed expense from employment income PNL. It's an allowed expense from employment income PNL. Now just think, my dear students, these three lines are totally related to employment income, and we can quickly do employment income working. Now wait, this first, if this lady is treated as employee, then there are few consequences. I hope you remember, and let me recall you. If this lady is treated as employee, then her income will be treated as employment income, and we have to apply employment income rules. Number one. Number two, if this lady is treated as employee, then she has to bear the burden of class 1 employee NIC. Class 1 employee NIC, you can take out the rates with you, you can keep the rates with you, and it will be given in the exam. If this lady is treated as employee, then she has to pay income tax on employment income. Okay, so three points. Number one, her income will be treated as employment income, number one. Number two, class 1 employee NIC she has to bear, and I will calculate in front of you. And number three, she has to bear income tax. Okay, let's start. We are not going to read the remaining question. First we are doing employment income part. Let's start employment income part. The first thing, she's treated as employee treatment. Now for employee treatment, we have to make employment income PNL. We have to make employment income PNL. First of all, we'll write the salary, my dear student, is just 44,000. Be confident, this is very, you can easily understood this. Now less one allowed expense, occupational pension contribution. Occupational pension contribution is 5% of 44,000. 5% of 44,000, I think 2,200. Let's simply take the difference between these two. 41,800 is your employment income. 41,800 is your employment income. Okay, now a very quick thing, listen, very easy. You guys are no more kids. No other income given in the question, only employment income. So this will be her total income, and this will be her net income, and this will be her ANI. And my dear student, when your ANI is less than 100,000, when your ANI is less than 100,000, you get a fixed personal allowance of 12,500. You get a fixed personal allowance of 12,500. So let's subtract the personal allowance. So your taxable income here is 29,300. Now good news, just think, this income is purely employment income, which is non-saving. This income is purely employment income, which is non-saving income, my dear student. And if your non-saving income is less than 37,500, you will have a flat tax rate of 20%. As this is less than 37,500, so we'll apply a flat tax rate of 20%. Flat tax rate of 20%. So 29,300 times 20% makes 5860, right? So this is your income tax liability. This is your income tax liability. Very easy peasy working. Giving you 30 seconds, giving you 30 seconds. Just look at it. Just look at it. Now, as she is employee, in this first case, she is employee, so she has to bear class 1 employee NIC. I hope you can see the rates of class 1 employee NIC. For class 1 employee NIC, the first band is 8632. 8632. So the first band is exempt. For the 0 to 8632, the rate is 0%. 8632, the rate is 0%. Okay. And in the second band, the rate is 12%. The second band, the rate is 12%. Now just think, it's very easy. As her salary, wait, class 1 employee NIC is calculated on cash earnings, that is salary, bonus, and sometime mileage allowance received if it is given. In this question, cash earnings is only salary. Cash earning for this lady is only salary. That's why I have calculated class 1 employee NIC on salary. Okay, there is no bonus, otherwise I would have added the bonus in it as well. So very simple. First 8632, it's 0% rate, no need to show it. So the excess amount 44,000 minus 8632 will be taxed at 12%. So this is your class 1 employee NIC. Now, my dear student, look at here. If this lady is treated as employee, so what will be the consequences? She has to bear income tax of 5860. Open your eyes. If this lady is treated as an employee, she has to pay income tax of 5860, and she has to bear class 1 employee NIC of 4244. Okay, if you understood this, kindly hit a message on WhatsApp. Come on, all of you, kindly hit a message on WhatsApp. Okay, my dear student, now we are going towards the second alternative. This lady is given a second alternative by the employer. Second offer. Read the second offer. This is the real offer now. Now, let's read the second offer. Let's read the as an alternative to being employed, Quick Speed PLC have offered Carol the opportunity to provide delivery services to the company on a self-employed basis. Now, the details of the proposed arrangement for the year. Now, this teacher, just think it. In reality, she's a driver. You can think like a teacher. Now, the second option. She can work as a self-employed. Carol will commence being the self-employed. That means the business will start on 6th April 2019. Okay. And exactly they have given the year end of 5th April 2020. Now the good news is your accounting period and fiscal year is aligned. 5th April 2019 to 6th April 2020. No more basis period calculation is needed. Because the accounting period is exactly same as fiscal year. On the first two lines, I've just seen this. Now read the offer. Now her income will be treated as trading income. Okay, now keep the trading income rules in your mind. Her income from Quick Speed PLC is expected to be 47,000. This is the first trading income. We'll add, don't worry, this is pure income. Carol will also provide delivery services to other clients. Okay, now she's visiting faculty, so she will teach in other institute as well. She is visiting faculty, so she will earn from two places, one from this and one another amount from somewhere else. So her total trading income is 47 plus 13. 47 plus 13. Now Carol will lease a delivery van and 100% of the mileage will be for business purpose. Now she's doing business, so she has to incur expenses. She is doing business, so she has to incur some expenses. So she leased a car, and thus, yes, this leasing cost is full-time allowed expenses. If you have hired the car for business, yes, she has hired for business. So what is the leasing cost? 4,400 pounds is an allowed expense. 4,400 pound is an allowed expense. Then when she is unavailable, Carol will have to provide a replacement driver. See, she started hiring assistant, another drivers to deliver for Quick Speed PLC. This will cost her 2,800, and yes, she has hired driver for her business, so this is also allowed expense. So in these four lines, point number 2, 3, 4, and 5, point number 2, 3, 4, and 5, my dear student, two are incomes and two are expenses. So simply add both incomes and simply deduct two expenses. So you will get tax adjusted trading profit in seconds. You will get tax adjusted trading profits in seconds. Now one very important thing, may God help you. Point number 6, pension. Again, pension. Carol will contribute 3,000 gross, not net, gross, into personal pension scheme. Listen, if an individual is contributing in his or her if an individual is contributing in his or her own personal pension account, then this is not an allowed expense from any PNL. This is not an allowed expense from any PNL. Yes, you will get relief. You will get relief by extension of bands. You will get relief from the extension of your bands, but don't expect that this is an allowed expense. See, this is not occupational pension, this is personal pension. So don't expect that this is an allowed expense. Now this will provide her with the same benefits as the occupational pension scheme provided by Quick Speed PLC. Don't worry, I'll handle this. This is not for income statement. This is not for trading income. So now what's the second requirement? You can read in the question. Now we'll solve with trading income rules. Let's go to the software. Let's go to the spreadsheet. Now we are doing the self-employed part. Now in this case, she will be treated as a self-employed. You can see the question as well. What's the trading income? 47 plus 13. 47 plus 13. These were two incomes. And what are the allowed expenses? It's 4,400 and 2,800. 4,400 and 2,800. So in simple terms, your tax adjusted trading profit will be 52800. Tax adjusted trading profit will be 52800. Now listen to me. This is your tax adjusted trading profit. As she has no other income, just this income, so this will be her net income. This will be her total income, net income. And then look at here, this net income will go on the side. and we'll deduct gross PPC. We'll deduct gross PPC, which is again irrelevant. Wait, 52800 is your net income. 52800 is your net income. And if you subtract gross PPC of 3000, gross personal pension contribution of 3000 from this, you will get 49800. Your ANI, your adjusted net income will be 49800. Okay. Now wait, when your ANI is 49800, that means less than 1 lakh. If your ANI is less than 1 lakh, is equal to 49800, that means less than 1 lakh. So obviously you will get a personal allowance of 12500. Obviously you will get a personal allowance of 12500. So finally you will have a taxable income of, finally you will have a taxable income of 40300. You will have a taxable income of 40300. Okay. Now before going on the tax computation, this time your bands will be extended. I hope you remember this. This time your bands will be extended. On the day one, on my day one revision session, I told you that individuals tax bands are extended because of two reasons. Individuals tax bands are extended because of two reasons. Number one is gross gifted donations, and number two is gross PPC. You remember? Now let me give you a little insight. Sir, from which amount we'll adjust the bands? Wait, in this question, your relevant earnings, your relevant earnings is 52,800. You can see the trading income is relevant earning. So compare relevant earnings with gross PPC. Your gross PPC is 3000 and relevant earning is 52,800. I repeat, your gross PPC is just 3000, your relevant earning is 52,800. So the lower amount is gross PPC. So in this question, your relief amount, I use the word relief amount, or in exam kit it is written TRC, tax relief contribution, is 3000. So you will extend your band, with gross PPC in this question. Gross PPC, that is 3000. So what's your updated band? Check the updated band. Check the updated band is 40,500. Check the updated band, it's 40,500. Now you tell me, check your taxable income. Your taxable non-saving income is 40,300. Your taxable non-saving income is 40,300, and your first band, the capacity of your first band is 40,500. So luckily you don't need to go in the second band. All taxable all taxable income will fall in first band. All of the complete taxable income will fall in the first band. Okay. So now your income tax liability is 8060. Okay, right? Again I'm repeating you, this time your first band is not, basic rate band is not 37,500. We have just updated it with 3000. We have just updated it with 3000. Okay, so here you have income tax liability, now within seconds you can identify it. Sir, as this lady is a self-employed businessman, now I have already given you teacher's example, I've already showed you the slides. As this lady is a self-employed now, so she has to bear class 2 and class 4 NIC. Class 2 and class 4 NIC, luckily class 2 NIC is fixed £3 per week. Class 2 NIC is simply £3 per week. So you can easily calculate class 2 NIC, £3 multiplied by £3 multiplied by 52 weeks. So this come out to be 156. 156 is your class 2 NIC. 156 is your class 2 NIC. Now, one mistake which students do, and you don't have to do this. Class 4 NIC, open your eyes, please. Class 4 NIC is computed on tax adjusted trading profit, not taxable income. Look at the screen. 40,300 is your taxable income, and tax adjusted trading income is 52,800. So class 4 NIC is calculated on tax adjusted trading income, that is 52,800. Okay, now go and check. You have your exam kit, go and check the rates, go and check in examination, it will be given. First 8632, first band it's 0%, first band it's 0%, and from 8632 to 50,000 the rate is 9%, and over and above of 50,000 the rate is 2%, the rate is 2%. See, I have shown the working. First 8632 is 0%, so no need to write, no need to write first 8632. And 52,800 minus 50,000, 2,800 times 2% is I think 140, 56, sorry. So this is all what class 4 NIC is. Okay, so that's what the case 2. In case 2, if she is treated as a self-employed, what are the tax consequences? Again I repeat, her income will be treated as trading income. You have to apply trading income rules first. Number 2, she has to pay income tax, number 3, she has to pay class 2 NIC and class 4 NIC. Okay, now the data is ready, and now listen my words very carefully. In such questions, you might have done such questions in your exam kit, in your old exam kit, or some teachers teach this question. Ali Patel of employment income, that's also like this. And similarly this Carol Courier, this is also a very famous question. Now finally listen my words, finally we have to take decision, this lady has to take decision that which option is better, take out your pen and write on a pen and paper. That decision making will be done on cash basis, pure inflows and outflows. I repeat, the final part you can read the requirement, the final part we have to decide which option is better. So for that part you just have to think about inflows and outflows. Whatever option will give you net cash inflow, more net cash, higher net cash inflow, you have to go for that option. That's it, pure monetary basis, okay, right? Let's start the last point. Okay, now one option is employed and the second one is self-employed. Now use your brain. If you are an employee, definitely you will receive salary was I think 44,000, this is inflow. In the self-employed, and then if you are employee, then you have to pay occupational pension contribution, that's the outflow, occupational pension contribution. Now wait, let me tell you one word. Occupational pensions are paid, the actual gross amount is paid. Okay, so I think it was 5%, 2,200. Okay, so you are receiving salary of 44,000 and you have to pay pension contribution exact of 2,200, because occupational pension contributions are exact gross, are paid gross. Then you have to pay income tax, income tax we calculated 5860. Then you have to pay class 1 employee NIC. we have to pay class 1 employee NIC. I think it was 4244. Okay. So these are the all cash flows if you are an employee. If you are an employee. These are the all cash flows if you are an employee. See, the net inflow is 31696. If you are an employee, the net inflow is 31696. Okay. Now, the second case is self-employed. The second case is self-employed. In self-employed, you will be getting just everything. 60,000 is your income and 7,200 is your expenses. So obviously the net inflow is 52,800. In self-employed, the net inflow is 52,800. The net inflow is 52,800. 52,800 is the net inflow. 52,800 is your net inflow, right? Okay. Then now in this case you have to pay personal pension contribution. Now a little test of your knowledge. Personal pension contributions are paid net, means you just have to pay 80%, remaining 20% contribution done by the government. So what was the gross amount? Gross amount was 3,000. Just simply multiply 80%. 80%, 3,000 times 80% is 2,400, and you have to bear only 80% payment. You have to pay only 80% from your own pocket. The rest amount will be contributed by government. So 3,000 times 80% is 2,400. This is your outflow. Then in this case you have to pay income tax, NIC, and income tax as well. Income tax in this case we just calculated is I think 8060. Income tax here is 8060. And in this case you have two NICs, class 2 and class 4. Class 2 and class 4. Class 2 is 156 and class 4 is 3779.12. 3779.12. Okay. So these all are the cash flows for self-employed. These all are the cash flows for self-employed. Now just simply check what's the total. Okay. So now you can say which option is beneficial. Which option is beneficial? Openly you can see that self-employed option is beneficial. Self-employed option is beneficial. Self-employed option is beneficial because in self-employed you are getting more net cash inflow. In the self-employed you are getting more net cash inflow. In the self-employed part you are getting more net cash inflow. Okay. In the self-employed part you are getting more net cash inflow. So in the end you have to write that going for self-employed option is better. Going for self-employed option is beneficial for Carol. Okay, look at this whole solution. Look at the whole solution and kindly hit a message if you got it. This is not that much difficult. You just need basic rules. You just need to memorize. Just need to learn basic rules and then you can easily do it. Okay. And plus this software is very user friendly. This software is very user friendly. You can easily do it. If you got it, kindly hit a message on WhatsApp. Kindly hit a message on WhatsApp, please. I repeat, for self-employed, listen, for self-employed, if you are paying in your personal pension contribution account, so you just have to pay net amount, and net amount is equal to 80% of gross. And this is basically a relief. That means, listen to me very carefully. You just have to pay 2400 in the account, but 3000 will be reflected in your account. I repeat again, you just have to pay 2400 net in the personal pension account, but you will get relief on 3000. So this is an additional relief, that by paying only 2400 you will get relief of 3000. So basically they are motivating you to contribute in personal pension. Okay, so this is basically a relief, that you have to pay net, but you will get benefit on gross amount, but you will get relief on gross amount. Okay, and as we were doing the last part was pure inflows and outflows of cash. The last part was pure inflows and outflows of cash. That's why I use net amount. But again, a question, sir, in occupational pension contribution you write exact 2200. In occupational pension contribution you write 2200. Why? Because occupational pension contribution are always paid gross, are always paid gross. One question. Listen, PPC is not an allowed expense. I repeat, personal pension contribution by an individual. If I repeat, if an individual contribute in his or her own personal pension account, then this contribution is strictly not an allowed expense from any PNL. This contribution is strictly not an allowed expense from any PNL. Yes, wait, if a person is employee and employee is contributing in occupational pension scheme, then yes, this occupational pension contribution by employee is an allowed expense from employment income PNL. Okay, so it's time to say goodbye, and tomorrow we'll be doing inshallah corporation tax, a very important area, the 20 minimum 20 marks of your area. Tomorrow we'll be doing corporation tax the same time, so stay tuned. Allah Hafiz.